A dollar invested at 8% net grows to approximately $2.16. That same dollar at the full 10%, no fees, grows to $2.59. The difference, 43 cents per dollar, went to the manager on a $10 billion fund. Over 10 years, that fee drag transfers roughly $4.3 billion from investors to the people running the fund. So to summarize, you provide the capital, bear all the risk, and pay $200 million a year for the privilege. Very equitable arrangement. In 1988, a mathematician built the greatest investment fund in the history of financial markets. 66% average annual returns for 30 years. Unbeaten, untouched, not even close. His name was Jim Simons. His net worth at death, $31 billion. Here's the thing nobody puts in the headline. You couldn't invest in that fund. You still can't. It was never available to the public. Not to pension funds, not to endowments, not to you. It was exclusively for his own employees. What Simons sold to outside investors was something else, something that performed considerably worse. Same name on the door, different product inside, and that one detail, that the greatest investor alive kept his best work for himself and sold everyone else a lesser version, tells you almost everything you need to know about the 10 names we're about to go through. 10 men, roughly $200 billion in combined net worth, built on a fee structure, not a technology, not a discovery, a sentence. 2% of your money every year, 20% of the profits, 0% of the losses. And the money they've been running that sentence on, a significant portion of it belongs to American teachers, nurses, firefighters, police officers, who mostly have no idea. If their fund goes up, the manager gets rich. If it goes sideways, he still gets rich. If it loses money, he gets rich more slowly. If it completely collapses, he starts a new fund. The pension fund tells its retirees to expect reduced benefits. Welcome to the 10 richest hedge fund managers in 2026. Let's start with what everyone agrees on, before we get to what nobody wants to say out loud. Now let's do this properly, because before we pull anything apart, you deserve to know what the financial media actually says about these men. The version that gets taught in business schools. The version on the book covers. Number 10, Paul Tudor Jones. Tudor Investment Corp. Net worth approximately $8 billion. In 1987, he predicted Black Monday, the single-day market crash of 22%. He didn't just predict it, he shorted it, made 100% return in a year when the market collapsed. There's a documentary about it. He later tried to have it suppressed, which is its own story.
In the next 10 to 20 months, and it will be earth-shaking, it will be saber-rattling, and it'll have Wall Street in a tizzy, and it will create headlines that will dwarf anything that's happened at this point in time.
Number 9, David Shaw. D.E. Shaw. $8 billion. Quantitative pioneer. So respected for his intellect that a young Jeff Bezos left a perfectly good Wall Street career to work for him. Bezos eventually left to start something called Amazon. Shaw stepped back from active management years ago. He still collects. Number 8, John Paulson. $6 billion. In 2007, Paulson made what is arguably the greatest single trade in financial history. He shorted the U.S. housing market, bet it would collapse, when almost nobody believed it would. When it did, he made $4 billion personally in a single year. 1 year, one trade, $4 billion. Number 7, Paul Singer. Elliott Management. Approximately $6 billion. Known as the most feared activist investor on Wall Street. Once seized an Argentine naval vessel in a Ghanaian port as collateral on a sovereign debt dispute. Not a metaphor, an actual warship, an actual port. Number 6, Israel Englander. Millennium Management. $12 billion. Lower public profile than most on this list. Paid himself over $3 billion in a single year, 2022. Doesn't do many interviews. Doesn't need to. If this list is already surprising you, hit subscribe, because the numbers get stranger from here. Number 5, David Tepper. Appaloosa Management. $21 billion. Made $7 billion in 2009 by buying bank stocks at the absolute bottom of the financial crisis when everyone else was selling. Also owns the Carolina Panthers. Moved to Miami a few years ago, and that detail becomes relevant later, not for the weather. Number 4, Steve Cohen. .72. $21 billion. His previous firm, Sac Capital, paid $1.8 billion in fines in 2013, the largest insider trading settlement in history at the time. Cohen was personally banned from managing outside money for 2 years. He waited, rebranded, relaunched as .72. He now manages outside money again. Also owns the New York Mets, which he bought for $2.4 billion. Number 3, Ray Dalio. Bridgewater Associates. Somewhere between $15 and $18 billion. Founded the world's largest hedge fund. Wrote a book called Principles that Fortune 500 CEOs cite in interviews. Built a corporate culture so intense that former employees have described it in various press accounts and legal proceedings as something adjacent to a cult. Dalio Dalio stepped back from day-to-day management in 2022. Number 2, Jim Simons, Renaissance Technologies, $31 billion at his death in 2024. The Mathematician, the Medallion Fund, the 66% annual returns. We'll come back to what his outside investors actually receive. Keep that thought. Number 1, Ken Griffin, Citadel, approximately $43 billion. Paid himself $4.1 billion in 2022 alone. The single largest annual hedge fund manager payday ever recorded. Spent $238 million on a Manhattan penthouse. Citadel has genuinely strong long-term performance. Griffin is, by most honest measures, the real thing. He's also the exception the industry uses to justify everything else. But what most people haven't noticed is that the wealth on this list and the performance of the funds on this list are two very different stories, and the gap between them is where this gets interesting. To understand that gap, you need to understand one thing: 2 and 20. That's the fee structure that built this list. 2% annual management fee on total assets. 20% of all profits above a certain threshold. Sounds reasonable in the abstract. Let's do the math in the concrete. Say a hedge fund manages $10 billion, modest by the standards of this list, where Bridgewater managed over $100 billion at its peak. The 2% management fee generates $200 million per year. Before a single trade is placed, that $200 million arrives whether the fund goes up, goes sideways, or loses money. It is not contingent on performance. It is contingent on assets existing and being managed. Now say the fund has a decent year, returns 10%. That's $1 billion in gross profit. The 20% performance fee takes $200 million of that billion. The investor's net return, 8% on their capital, after paying out 4% of the total fund value in combined fees. Do that over 10 years, compounded. A dollar invested at 8% net grows to approximately $2.16. That same dollar at the full 10%, no fees, grows to $2.59. The difference, 43 cents per dollar, went to the manager. On a $10 billion fund, over 10 years, that fee drag transfers roughly $4.3 billion from investors to the people running the fund. So to summarize, you provide the capital, bear all the risk, and pay $200 million a year for the privilege. Very equitable arrangement. Now, the industry's defense of this fee structure rests on one word: alpha. In plain English, returns above what a passive index fund would give you for free. If the hedge fund genuinely generates alpha, if it beats the market consistently, then paying for that outperformance might be rational. The fee is the price of access to something you couldn't get elsewhere. So the question the entire industry rests on is, do these funds actually generate alpha consistently, net of fees, over time? Keep one name in mind as we answer that: Warren Buffett. Because in 2008, Buffett made a public, documented $1 million bet. His wager, a simple, low-cost S&P 500 index fund, would outperform a professionally selected portfolio of hedge funds, net of all fees, over the following 10 years. A fund of funds manager named Ted Sides took the other side. 10 years later, the result was in. Buffett's index fund, 85.4% return over the decade. The hedge fund portfolio, 22.0%. Not a close loss. Not a valiant effort that fell slightly short. 85 versus 22. The index fund won by 63 percentage points. And before you say it was one bet, one portfolio, one decade, the S&P SPIVA report, which tracks active manager performance systematically across thousands of funds, shows that over any rolling 15-year period, approximately 90% of actively managed funds underperform their benchmark index. 90%. For hedge funds specifically, which charge dramatically more than regular active managers, the performance gap is worse, not better once fees are accounted for. The average hedge fund has underperformed a basic 60-40 stock and bond portfolio in most rolling 10-year periods since 2010. Now you understand the machine. The next question is, who does it actually work for? Here's the question that should be bothering you right now. If the performance data is this clearly documented, if Buffett won by 63 percentage points, if 90% of active managers underperform, why do pension funds keep allocating billions to hedge funds year after year after year? The answer is not stupidity. The people running pension fund investment committees are not stupid. The answer is incentives. A pension fund investment officer who allocates to a famous hedge fund and underperforms has a defense: we hired the best available managers, the market environment was difficult. These things take time. A pension fund investment officer who allocates entirely to index funds and underperforms for a single year has no defense, because the whole point of index funds is simplicity. Failure is visible. Accountability is unavoidable. Complexity is career protection. There's also a consultant layer between pension funds and hedge fund managers, advisory firms that pension funds hire to recommend allocations. Those consultants are evaluated on whether they're providing sophisticated, defensible advice. Recommending a famous exclusive hedge fund is sophisticated. recommending Vanguard is not, regardless of which one performs better. The pension beneficiary, the teacher, the nurse, has no visibility into any of this. No access to which funds their pension allocates to. No plain English breakdown of what fees are paid. No comparison against what a passive benchmark would have returned. That information exists in filings. It is practically inaccessible to the person whose retirement is actually at stake. Now, remember Jim Simons. Remember I said the fund that made him $31 billion was never available to outside investors. Here's what they actually got. Renaissance's outside investor funds, Reef and Rida, returned approximately 8 to 9% annually before fees over a comparable period. The S&P 500 returned roughly 7%, so modestly better. After Renaissance's above standard fees, the net return to outside investors was approximately in line with, and in some periods below, what a free index fund delivered. Same name on the door, different product inside. But anyway, Simons is the most honest version of a practice that runs much deeper. Let's talk about Bluecrest. Michael Platt. Bluecrest Capital. Net worth approximately $15 billion. In 2015, Bluecrest made a quiet announcement. It was returning all outside investor capital, converting to a family office, managing only partners' money going forward. The explanation given was vague. Strategic refocus, changing market environment, standard language that means nothing. The real reason emerged in 2020 via an SEC investigation. Bluecrest had been internally routing its best trading talent, its most experienced, highest performing portfolio managers, to trade the partner's own capital. Outside investors were being managed by a less experienced internal team. The A team traded the house money. Outside investors got the B team. Both paid the same fees. Bluecrest settled with the SEC for $170 million, without admitting wrongdoing, which is the financial industry's version of allegedly. Now here's the part that should sit uncomfortably. Bluecrest isn't unique. The structural incentive, maximize returns on the money you personally own, give outside investors what's left, exists at every fund where partners manage both proprietary and client capital simultaneously. Bluecrest is the most documented case because it was unusually explicit and because it got caught. Hedge funds are not required to disclose how internal talent is allocated between proprietary and client capital. That data doesn't exist publicly, which is, as always, convenient. Smash that like button if this is making sense, because the tax section is somehow more infuriating than everything we've covered so far. Now to play devil's advocate. These managers have skin in the game. Their own capital is invested alongside clients. If the fund blows up, they lose too. Doesn't that protect investors? It sounds compelling until you run the fee math. The management fee, 2% annually, is income regardless of fund performance. A manager running $10 billion collects $200 million per year before placing a single trade. The downside of a bad year is a reduced performance fee, not a loss of the management fee, not personal financial devastation, a slower rate of enrichment. The skin in the game argument assumes the pain is symmetrical. At these asset levels, it isn't. Now let's talk about the carried interest provision, because this is the tax structure that sits underneath everything else on this list. When a hedge fund manager earns a performance fee, the 20% of profits, that income is classified for tax purposes as carried interest, and carried interest is taxed at the long-term capital gains rate. In 2026, that rate is 20% for high earners. The marginal income tax rate for a surgeon earning $500,000, 37%. For a teacher earning $60,000, 22%. For Ken Griffin on $4.1 billion in performance fees, 20%. The argument for this treatment is that performance fees represent a share of investment gains, and gains have historically been taxed at lower rates to encourage capital formation. The problem is that the performance fee is income for services rendered. The manager didn't invest their own capital to earn that 20%. They invested other people's capital. By any plain English definition, that is compensation. That is income. The Congressional Budget Office has estimated the carried interest provision costs the U.S. Treasury approximately $14 billion annually. $14 billion a year in tax revenue that isn't collected from people whose combined net worth exceeds the GDP of most countries. Congress has debated closing this provision for more than 20 years. It has never closed. And oh, would you look at that. Ken Griffin donated over $50 million in political contributions in the 2022 election cycle alone, across both parties, to candidates who in aggregate have not closed the carried interest provision. The provision keeps surviving. The donations keep arriving. For those keeping track, remember when I said Tepper moving to Miami was relevant? In 2016, David Tepper changed his domicile from New Jersey to Florida. New Jersey subsequently reported a significant gap in its capital gains tax projections. The state's governor publicly stated that Tepper's move had cost New Jersey hundreds of millions in tax revenue. One man, one address change, hundreds of millions. Florida has no state income tax. Carried interest minimizes minimizes federal tax. Domicile selection minimizes state tax. The full optimization architecture, working as designed. Now there's one more layer to the performance story that the industry never leads with. Hedge funds close at a rate of approximately 10% per year. 1 in 10 funds every year shuts down, usually due to poor performance or client redemptions. When a fund closes, it stops reporting to performance databases, which means every database of hedge fund returns only contains funds that are still alive. By definition, the better performers. The funds that lost the most money, charged the most fees for the worst results, they're not in the average. They disappeared from the sample. This is survivorship bias, and it means every published average hedge fund return figure you have ever seen is optimistic by construction. The actual average, including the graveyard of closed funds, is worse, meaningfully worse. We can't calculate exactly how much worse because the dead funds stopped reporting. The performance statistics used to justify this industry are built on a sample that excludes its worst outcomes. That's not a minor footnote. That's the whole game. Either way, zoom out for a second, because this stops being a story about 10 rich men and starts being a story about what happens when the people making decisions aren't the people living with the consequences. The pension beneficiary, the teacher, the firefighter, the nurse cannot opt out of this system, cannot choose their pension fund's allocations, cannot audit the consultant's incentives, cannot close the carried interest loophole. The decisions that determine what happens to their retirement savings operate entirely above their pay grade in the most literal sense possible. The reforms exist on paper. Close carried interest, mandate that pension funds benchmark performance against passive alternatives and disclose fees in plain English, require transparency on internal talent allocation at funds managing both proprietary and client capital. None of these are technically complicated. All of them are politically expensive, and the people for whom they're politically expensive are the people whose names appear at the top of this list, who happen to be, not coincidentally, among the largest political donors in the country. The window for reform has been open for 20 years. The provision hasn't closed. The list hasn't shrunk. We started with Jim Simons, the greatest investor who ever lived, the 66% annual returns, the fund that changed everything that you couldn't invest in. That detail isn't a quirk of one man's fund structure. It's the operating principle of the entire industry. The best of what these managers do is reserved for themselves and their inner circle. What gets sold to pension funds, endowments, and outside investors is the brand, the reputation, the name on the door, not the product. The list of the 10 richest hedge fund managers in 2036 will almost certainly be longer. The numbers will almost certainly be bigger. The pension funding gap will almost certainly be wider. And the teachers and nurses whose retirement money started this conversation will still have no seat at the table where any of it gets decided. The fund that made Jim Simons $31 billion was never available to you. It still isn't. And in a way, that's the whole story. And don't forget to like and subscribe to keep on learning how money works.